you're going to lose your money. It could be a desperation of fear that you're going to lose your opportunity. It could be, anything related to any of that. Just a sudden fear or a sudden emotional burst, and you're like, oh, I got to do this right now. When you have that emotion of I got to do this right now, you're going to get a bunch of gaps when you have the majority of market participants that feel that way. It can also just be as simple as an influx of overnight orders. Sometimes, you just get to a time when more people decide they're ready to buy or sell, and maybe there's not a whole lot of logic to it, but it could be enough that it could create a gap the next morning. The bottom line, the thing that's really, really important to remember, is the gap is really just simply the result of the market makers trying to make the market. The market maker wakes up in the morning, they go into the office, and they look there and they say, why goodness, I have 10,000 people that are ready to buy this stock, and I've only got 1,000 people that want to sell it. Or worse, I have nobody that wants to sell it. So in order to entice sellers, what's the market maker have to do? The market maker has to raise the price to entice the sellers. That's going to distract from some of the buyers. As they raise the price, they attract sellers. Now they can make the market because you got buyers and sellers that are finally agreeing upon a certain price. Okay, so that's the idea behind a gap. The gap is really just the market maker trying to find the buyers and the sellers and where we can possibly make that market. Okay? DG has said overnight is not after hours then. I'm not sure exactly what you're referring to, but overnight means while the market's closed. After hours, there's a specific time period from when the market closes that actual trading can continue. We call that after hours trading. And that's oftentimes when a lot of market announcements are made. A lot of earnings announcements are made after the market technically closes at 4 o'clock, but before after hours trading is done. So, there's a distinction between overnight and after hours in that sense right there. Okay? All right. Peter says, what club does someone have to belong to trade after hours? Well, you just have to have a broker that will let you place trades after hours. Actually, a lot of your brokers will let you do it. I don't personally think you should trade after hours. It's a very small cross-section of market participants that do it. And, I've never been a big fan of trading after hours, Peter, but if you want to get into that, then call your broker and ask them how you can manage those trades after hours, and they'll probably hook you up. All right, let's talk about a common opening gap. Getting into some qualifications here. Take a look at this picture, and if you don't mind, would you please tell me between which two letters do you believe there is what I'm going to title a common opening gap? And yes, this is a trick question. Common opening gap. Where do you see this formation? Common opening gap. While you're looking at that, I'm going to answer Beata's question. The question is, so Forex does not gap? And the answer is typically no. Forex does not typically gap, and the reason is it's a 24-hour market. Now, you might have a very, very small gap between ticks, but market closes and it reopens at the exact same time. So from Sunday night all the way through Friday, you pretty much have a 24-hour market in the world of foreign currency. And so no, you do not end up with a bunch of gaps there. But then what you will find is between Friday night and Sunday night, when they reopen the market, you will find a gap sometimes on Sunday evening. So yes, it does gap, but not on a daily basis. Okay? All right, most of you said that the common opening gap is between D and E, and that would make sense based on your limited knowledge of gaps, but that's not my question. I said it was a trick question. I even told you it was a trick question. I said, where is the common opening gap? And I said it's a trick question. What's the definition of a gap? The definition is when the opening and the opening price of one day and the closing price of the previous day do not match. And so if you look at that definition, there's actually two gaps on here. And between C and D is the one I was going for, because you see that the closing price of C does not match the opening price of D. Does that mean D and E is not a gap? No, D to E is a gap, but it's not a common opening gap. The common opening gap occurs very, very often. In fact, many, many stocks gap almost every morning. It's a very, very common occurrence. And it's really important to recognize that most of the time, the stock fills the gap during that morning. In fact, statistically, it's within the first 30 to 45 minutes of the morning. Most of the time, whenever a stock gaps in the morning, it will fill that gap. It will completely trade. The terminology fill the gap means that it will replace that formation. So in the case of D to E here, had we opened up here and then traded bearish, we would have filled that gap, and now there's no void in trading. You see what I'm saying? In the case of C to D, we gapped down, and then the bulls actually came back in and continued the day. And so even though we had a bearish gap early in the morning, we actually filled it up very, very quickly and continued trading. Common opening gaps are, as the name suggests, quite common. They occur very often, and they really do not mean hardly anything at all. You do not need to sit here and scratch your head and say, why did that happen? It doesn't matter why it happened. It's common. It happens all the time. And the important thing to know is they almost always fill during the day. Again, statistically, it's within the first 30 to 45 minutes of the day. It doesn't have to be, but sometimes it is. And as a trader, the valuable thing here is to just know that most of the time your gaps are going to fill during that same day. Now, what happens when it doesn't fill? That's the study of gaps that we're going to talk about. But most of the time, they do fill during the day. People often say, why do these common opening gaps happen? And it's for lots of reasons. Stock liquidity can cause it, meaning, let's say that you just don't have that many people trading the stock. I mean, you look at a lot of penny stocks. Penny stocks gap all the time because you have very poor liquidity. You don't have a whole lot of people that are trading them. Stocks that have very low volume are going to gap often because you just don't have people trading them that often, and that's why it happens. You can also get an ex-dividend gap, meaning the day after the dividend is paid, you're going to get a gap, typically speaking, and that gap is just an adjustment of the value of the stock, and very often that ex-dividend gap actually fills within a few hours of that day. We also get what we call a suspension gap. Now, suspension gap is the result of a 24-hour market. Let's take, for example, silver and gold. The ETFs, ticker symbol SLV for silver or ticker symbol GLD for gold. These are ETFs that trade silver and gold. And because the silver and gold ETF, that's an exchange-traded fund, because they trade on the stock exchange, they close when the stock exchange closes at 4 o'clock. But silver and gold as a commodity continue to trade overnight around the world in 24-hour markets. So what happens is overnight, the price of gold might change, or more specifically, the price of the currency might change, which is also a 24-hour market trading around the world. And so as the price of the value of the currency changes, the value of the price of gold and silver changes, when they open the ETF the next morning, what do? They have to adjust for those value changes that occurred overnight. Don't be so arrogant as to think that you are the only person trading the markets. You're not. People on the other side of the world are trading as well. And while you're sleeping, Asia is not, London is not sleeping, and the rest of the world is not sleeping. So that's what's happening on the other side of the world. It's daylight for them. They're trading on their day, just like you're trading on your day, and their prices go up and down during the day, just like your prices go up and down during the day. And then when the day cycles back around and it's your morning again, guess what has to happen? We have to revalue. Now, this doesn't just happen for silver and gold. It happens for certain stocks such as BP, British Petroleum. It happens with PBR, which is Petro Brazil. Even though Brazil is in our hemisphere, or in our time zones, almost in our time zones, what happens is they actually open an hour or two, depending on the time of year, before the New York markets, and during that couple of hours of the day, PBR can change price quite a bit. And so when the U.S. markets open, down in Brazil, they're trading PBR, then U.S. markets open, they have to revalue very, very quickly. And so that's one of the ways that the 24 hours or the suspension gap can occur. In case of British Petroleum, BP trades in London, and it also trades in the United States. In the case of Toyota, it trades in Japan. It also trades in the United States. And so these stocks can get what we call a suspension gap, as you just have a quick quick revaluation first thing in the morning. All right. Sometimes you get a minor news story or a news story that people think is a news story, and it turns out that it's not. And so you can have sudden reactions to a news story overnight. That can create a morning gap that, again, fills very quickly, and it's not that important. Okay, so those are the natures of common opening gaps. Again, most of the time they fill. You don't need to freak out about them. Now, let's get into the important gaps, and I call these the major gaps. There are 3 qualifications of major gaps. We've got the breakaway gap, the runaway, also referred to as the measuring, or sometimes you'll hear it as a continuation. You can name them all sorts of things. Breakaway, runaway, and exhaustion. Breakaway, runaway, measuring, continuation, all the same formation, and the exhaustion gap. All right, let me tell you some basic rules here in terms of general gap principles. Most of the time, more often than not, major gaps occur because of news. If there is no news tied to the gap, then watch, because one day there probably will be news. And it may be, later that day. It may be in a couple, 3 or 4 days. What will happen at times is there is something known as insider trading, where the news leaks out, but it's not been public news. And so you don't know the news, and you actually see a gap because somebody did find out the news, and they actually forced a gap in the market because they reacted so strongly. And so if you ever see a gap, a major gap, and there's no news tied to it, pay attention, because there's a good chance that there's going to be news coming out. Okay, that's just a little tidbit for you there. Usually, most of the time, news is the driving factor of a major gap. The gap is a major gap as long as it remains open, meaning as long as there's a gap, it's a major gap. Okay, so in this picture that I've got over here, you see my gap here. Well, that's open. We've not had any trading in that price range. Now, if the stock came up and it turned right back around and it came all the way through and it filled that whole trading range, that's no longer an open gap. Okay, but as long as the gap is still open, then it's a major gap. If the gap fills, which is what I just drew out there for you, then the odds of it playing out the way that I'm about to explain them to you, then the odds of it playing out are very minimal. And you're going to have to just basically let it go and say, well, that one didn't play out the way I thought it was going to play out. It might still come around, but not because of the gap. If it plays out, it's because of something different. Okay? So let's get into some breakaway gaps, and I'll break these down for you, pardon the pun. The breakaway is going to occur during a market turnaround. So oftentimes it will be after a major reversal pattern, right? Because those are market turnarounds. Going to occur during a major market turnaround. It marks the beginning of a new trend. And because it's a new trend, the breakaway gap is the most profitable gap. In fact, the breakaway gap is about the most profitable chart pattern you can find. If you find a good breakaway gap and the trend continues from there, you should jump on board and you should hang on with dear life, because there's a good chance that you've got a major trend coming. Very often that could be a doubling or a tripling or better of the stock price. Not guaranteed, obviously, but very often when you see big moves in stocks, they often come after breakaways. That's what I'm trying to say. They usually occur after a major reversal or consolidation pattern, and you obviously want them to occur with high volume. So take a look at this picture right here. Notice that I've drawn a double bottom in here, and then we have our breakaway gap. You see that? It's breaking away literally from the double bottom. We'll label it BA for break away. All right, now let's come over and look at some real world examples. Take a look at this breakaway gap right here. You see it came after a major bottoming pattern. What was this formation, ladies and gentlemen? Based on what we learned in the last class, what is that chart pattern formation? That chart pattern formation is a inverse head and shoulders. Very good. Okay, so we've got an inverse head and shoulders, and the break of the neckline actually came with a breakaway gap. Okay, now what does that mean? Well, it means it's probably the beginning of a new trend. We've got a breakaway gap, which most of the time signals a new trend, And we've got an inverse head and shoulders, which is a bullish reversal pattern, reversing from a bearish move up to a bullish move. And in this particular case, we moved from $60 a share to $90 a share in 1 to 3 months. That's a pretty good move. Wouldn't you guys agree with that? By the way, look at the time period for this. This was the end of 2008. That means that this move right here was the crash of 2008, September, October 2008. During this time period, from October through January, February, we had a major inverse head and shoulders, which is a type of a consolidation / reversal pattern. And then as the market started to reverse, we broke out with a breakaway gap that jump-started that trend. Okay, so there's a breakaway gap. Now, this is a bullish breakaway. Let me show you a bearish breakaway. This is a bearish breakaway gap. This one actually also came after a major pattern. You can draw this a couple ways. You can look at it this way and say, oh, there's a consolidation pattern. It looks like a channel went on for months. Or you could look at it, I actually showed you this in the last class, as a complex head and shoulder. Either way, you got a breakaway gap, and that breakaway signaled the beginning of a new bearish trend. And in this case, we traded over the period of 2 months. Is all it took to go from $110 a share all the way down to 70 bucks a share. And interestingly enough, there's another formation here. Take a look at this formation. We've got a little bit of a wedge pattern. Now, this was a falling wedge that actually broke bearish. So that one kind of broke the rules a little bit there, but it was part of the bigger trend. A little wedge formation there in the midst of that. But that's not the point of this discussion. It's all about the breakaway gap. All right. See, sometimes you learn to recognize these patterns, and it's all you can do. You see them, you have to say it, right? All right. Good question. Kevin says, wasn't that gap earnings? And the answer is probably. Kevin, is earnings a news event? The answer is yes, earnings is a news event. Very, very often, the gap comes on an earnings announcement. Very, very often. Yes, for sure. Okay, now let's take a look at another gap here. This one is on Schlum. And take a look here after a major bullish move. This was a very, very fast reversal. We just traded, kind of topped it out here for about 4 days, gap down, and boom, we were off and running. Now, this particular one was a little bit different because we did run down all the way down to about $90 a share after being about 105. But watch what happened. We quickly came back, retested this old support as a new resistance. You see that right there? We came back, we retested it, and then the trend continued. You see that trend continuation right there? And then notice what happened at the end of this. This is interesting. Again, I didn't mark this, but here's a little bit of a rising wedge. Or sorry, it's a rising wedge. And in this particular case, it broke out as a bullish reversal as we were bottoming out here. Okay? Now, breakaway gaps. Assuming the gap or the empty space does not start to fill, you can assume that the trend will follow in that direction. Okay, so if you've got a gap, the stock has been making some sort of a consolidation or some sort of a reversal here, and it gaps away from it, you can assume that trade is going to continue in that direction unless it fills the space. Now, if it fills the space, then you can assume that all bets are off and you're going to have to use other analysis skills. But based on the gap itself, as long as that space is never filled, the gap is in play. Okay, if the gap fills, then it becomes of minor significance. And this is a very important point, this last point. In the future, this goes for all gaps, by the way. In the future, the gap space will be support and resistance. So in other words, in the future, you can mark the top and the bottom of the gap, and this is support and resistance in the future. That whole space actually becomes support and resistance. Okay? Bev says, what's the time frame for filling gaps? Well, Bev, with these particular gaps, maybe never. For the common opening gap, within a few hours usually. But for these particular gaps, sometimes it's never. Sometimes they fill in 3 or 4 or 5 days, and at that point, it's not important anymore. As long as the gap is not filled, it's not important. You see what I'm saying? All right, now let's talk about, I've got an example here of a breakaway that never really took off. This was on Oxy, and notice that we had the bottoming formation here. We had the breakaway, but look at the breakout. This is really interesting because it did not fill. You see, I can still draw my support level here, and that would have, about $81 would have been marking the fill spot. It never filled, but it never really took off. You see that? So this was, kind of a unique situation. You had a breakaway. It did eventually continue in the bullish trend, but it really took a long time to get going there. Now you compare that, which it's not really a failure, but it's just kind of a, lackluster move. Now you compare that with this particular one on MasterCard. This was a major gap. This is a major gap, broke bearish, and immediately, within a month, came back. It filled. It hung out there, and then it reversed, and it continued going in the bullish direction here. So that was a very, unique situation. This was a full-on breakaway failure in this particular case. Okay. It's also probably interesting to note that we actually had a bit of a wedge formation right here. Now, what would your qualifications be? Would you call that a rising or a falling wedge? You'd probably call that a falling wedge because the lines are really going downhill. And which way do falling wedges tend to break? They tend to break bullish, and that's exactly what happened on MasterCard. Okay? Pretty interesting, huh? Glendon says, how long do you wait to trade a gap? Not that long. Sometimes a few minutes. I mean, you see the gap again. If it's a major gap like this, you're going to see it very quickly. Within a day or two, you can... usually the same day, honestly. If it doesn't fill it that day, odds are it's probably not going to fill it. What you could do is like on this particular example, you would just set your stop. Let's say that you got up in the morning and it gapped and it started trading down. You would set your stop right at the high of the day. That would become your stop, and you could just go bearish, and it still would have taken, in this case, after a couple of days, you saw that it wasn't continuing. You would have maybe been questioning. But normally within 3 to 5 days, it should be continuing as the direction of the gap. Okay. All right. Let's come around here and talk about what we call runaway gaps. Runaway gaps are also called measuring gaps, and they're also called continuation gaps. What the runaway gap does is it shows that the market is moving well in a strong trend. And as the image suggests, it is often certainly after the trend has begun. Oftentimes it's after another gap, another breakaway gap. So this one up here would be the runaway gap. It is seen as a continuation pattern. And assuming the gap never fills, you can, again, trade in the direction of the gap. You can just jump in and go with that particular direction of the gap. Now, the next phase of the move, this is the interesting thing about the measuring gap. The next phase of the move can be measured based on the recent phase. So let's say that this top gap here is the measuring gap or the runaway gap. And let's say that this particular move was $20. Well, you can assume, based on history, that the next phase of the move will also be $20. So when you see a runaway gap or a continuation gap, it tends to run about as far as the previous phase of the move. All right, so let's take a look over here at some pictures here. This one's on ExxonMobil. This one came right after a little short-term retracement. Again, we had a falling wedge here. And a falling wedge gapped out in a bullish momentum here. We had a runaway, and we ended up moving from about $70 to about $85 a share. So we had about a $15 move, all in all. Okay, now that's a $15 move. Where had we come from? Well, we had come from about 60 up to about 70. So that was about a $10 move. And depending on where you jumped in here, you might have looked at it as around 65, but we'll call it a move from about 60 up to 70. So that was a $10 move, and yes, we could measure it. Actually, Interestingly enough, we ended up moving from 70 to 80 before the next big candle came in, which was right at the $10 phase. And that one happened over a couple of months, the acceleration there. But, sometimes they go fast, sometimes they go a little slower. But you can still see the idea of how fast it ran there. Okay? Now, let's take another look here of a runaway gap. And this particular one came in on Sears. You can see the bottoming formation here. Here is your gap. And this one jumped in here around about $59 a share, traded up to about 85. So in this case, we had about $25 move. And let's see where we had come from. This particular one went from about 55. It come from about 30 up to about 55. So that also was about a $25 move. Now that's pretty interesting, isn't it? And more often than not, your measure or your runaway gap will be a very similar move, similar size. Statistically, they tend to range from happening about the 40% to 50% of the way into a trend. So when you see a runaway gap, it's usually going to be somewhere between 40 and 50% of the way into how far that trend is going to run before you end up getting a rest or a reversal. These are all bullish here. Take a look at this bearish one on Wynn Resorts. And you can see that this particular runaway gap happened down here. Let's draw some lines and see where it happened. It happened around $80 a share. And it stopped running in about a month down here around 30. That was about a $50 share move. And the initial phase of this particular move, depending on where you started it, if you started it down here at this portion here, it'd be about a $20 move. Had you started it way up here, it was about 120 down to 80. So that was about a $40 move, all in all. So $40, and then it continued another 50. So that would go in line with my statement that it happens about 40% of the way into the trend. Then, of course, once we got into this cycle here, we consolidated for a while, and then it continued bearish where it really went to the bottom. All right, this is, interestingly enough, this is also a chart pattern. What kind of a pattern would you guys call this formation? What type of a pattern would you call this? This would be a triangle. Very good. Robert says, what is the time between a primary gap and a runaway? Robert, the assumption in your statement is that there's already a breakaway or an initial gap. There is not always a breakaway gap. So there is no time because you never know. I mean, they don't have to go together. Oftentimes they do, but they do not have to. Now let's take a look over here at a runaway gap that failed. This was a failed runaway gap. So depending on how you want to look at it, I could have actually called this top one a runaway gap as well. Obviously, the bearish trend had begun way back here in May. But looking at the second little runaway gap here, second little gap, we traded down. We immediately, within 4 days, filled the gap. We tried again, ended up with a double bottom, actually, and this thing reversed. Now look at where it stopped. It stopped right at the bottom of that first gap, meaning it's retesting that old resistance as a new, or old support as a new resistance. You see that? So the gap, again, you want to mark your gaps, especially if they're recent. You want to mark your gaps for support and resistance because they will show up as support and resistance in the future. Okay? This is ticker symbol ISRG, Intuitive Surgical. All right, let's take a look at exhaustion gaps. The exhaustion gap is the one that will freak you out a little bit. In the case of the breakaway and the runaway, when you see the gap, you can just jump in and you can go with the trade. The exhaustion gap appears at the end of a market move. And it can be confusing because initially what happens is it appears like it's a runaway gap. But what happens is the trend fails to get any kind of momentum after the gap, and it stops moving forward, and very often it just turns into a reversal. Now, just because it's an exhaustion gap, it does not mean it has to turn into a reversal. It can either turn into a reversal or it can turn into a consolidation period, but the important thing is that the trend dies with it. And so the momentum that you had for the nice bullish trend or the nice bearish trend seems to die with the exhaustion gap. Very often the volume dries up substantially. Sometimes you'll still see the volume on the gap itself, but right after it, the volume tends to dry up very, very quickly. And eventually the stock reverses and the gap gets filled, thus signaling the end of the trend. Anytime a gap is filled, you know that you don't want to trade in the direction of the gap. Take a look at this one on Garmin here. We've been through a nice bullish move from $30 all the way up to about $44, $45 a share. And we got a nice big gap out here all the way up to almost $50 a share. But immediately it came back. Now, it didn't fill. Notice that we did not fill. We still had a gap even after it came down. We got a small little line pattern. Now we actually gapped down and filled that whole space, and then we filled that whole space. And so what you saw happening here is we were just kind of moving back and forth. The spaces all got filled, and there ends up being no gap. That's an exhaustion gap. The exhaustion gap shows that the trend is exhausted. It's worn out. A lot of times the exhaustion gap is caused by latecomers, people who, it could have been an earnings event. It could have been people who've been watching this trend for a long time, waiting to get in. They saw it going up and up and up. Majority of market participants were already in the trade. And then you have maybe good earnings, and the latecomers jump in. They run the trade up, but they're the last money in. There's nobody left to buy. And so the selling pressure starts to come in. And you can see it took several months for this whole thing to reverse. But in the end, it did reverse, and we had a trend reversal. Let's take a look at this one on AutoZone. Again, we had a huge run up. In this case, we'd gone from less than $175 a share up to over $350. We gapped. We had the exhaustion gap right around the $350 mark, and it just never got traction. You see, it just kind of fizzled and fazzled. We didn't start to fill it yet. It just didn't gain traction. For 2.5 months here, finally, we had a little bit of a higher high, but then it just came right back down. It filled the gap. We bounced, and then what happened before you know it, you're in a consolidation. And so I can sit here and I can draw lines. It took a while to shape up, but in the end, you're in a consolidation period. Now, that's obviously an end of the trend because the preceding trend was a bullish move. Now we're into a sideways move, and before you know it, you've spent 6 months waiting for this trend to continue, and it doesn't continue. So the exhaustion gap, when you see one after a big bullish move, it's either going to be a continuation or exhaustion. And if it's big enough preceding trend, it's probably an exhaustion move. You probably need to sit out of it. A lot of times in Power Trader, you'll hear me refer to a gap, and you'll hear me say, be careful, this looks like it could be an exhaustion gap. And that's just a kind little friendly warning when you hear me say that, to say, don't assume this is a runaway gap. You can still jump in. There's a possibility it'll continue, but very, very often you can tell by the location on the chart whether or not it's an exhaustion, or whether the likelihood is high that it would be an exhaustion. Here's a bearish exhaustion gap. This one came in Sears. And again, in this case, we'd sold off very rapidly. We had a bearish exhaustion gap down, and it took, just a little bit of time. Very often, you see the formation here, how we were continuing lower, but it was just very, very small candles. That's very, very typical behavior of an exhaustion gap that does not have the momentum to continue. And instead, what happened? Volume dried up, and as the bulls came back in, volume came flooding in, thus justifying the bullish move. And we very quickly, after the bulls came in, we very quickly filled the whole gap, and the reversal came into play. Biggest confusion that I get from students on exhaustion gaps is they always say, how do you know? And the answer is, well, you don't. But there are ways to guess the likelihood. Is there a likelihood that if you have been trading in a bearish trend, you just channeled for 4 or 5 months and you gap higher, is there a likelihood that this is an exhaustion? And the answer is no. It's totally in the wrong location. That's going to either be a breakaway gap or nothing. Okay, so it's obviously not an exhaustion gap because it's at the end of a trend having already turned and made the reversal. Is it likely after a bullish move that you would get to the top and you would gap and it would be a breakaway? And the answer is no, there's no way, because it's the wrong location. So if you're in a big bullish move and you've been in it for several months, it's a long-term, intermediate, or even a primary trend, and you get a big gap out and it doesn't have a lot of momentum with it, it's probably an exhaustion gap. And so you have to just kind of use your noggin. Don't try to be too scientific about it. Just say, where's the location? Which location are we in? And if you're after a big trend, it's probably an exhaustion. If you're rounding out some sort of a reversal, it's probably a breakaway. And it's not rocket science, but sometimes people try to complicate it, and you really don't need to. All right, let's take a look at this picture and tell me, what do you think this could be? Any ideas what this formation could be? Take a look here. Just go ahead, based on what you've learned tonight, what kind of gap do you see? Bill says it is an X gap. Okay. I think he means an exhaustion gap. Okay, so several of you have said there's an exhaustion gap here. Nobody sees a breakaway gap? Could there be a breakaway gap? Anybody? No, says Oscar, no breakaway. You're blind, Oscar. There's an exhaustion gap on the left, but on the right, there's a breakaway gap. And this creates a very interesting formation. Technically, it's not a gap, but rather it's a chart pattern that we call an island reversal. The island reversal is an exhaustion gap followed by a breakaway gap. The time frame could be anywhere from 1 or 2 days up to several, 3 to 4 or 5 weeks. You don't usually see them 4 months apart, but you'll see them, anywhere from a couple days up to 4, 5, 6, 8 weeks apart maybe. And what happens is the trade gaps as an exhaustion. It usually forms some sort of a little reversal, and then you get a breakaway in the opposite direction. This is a solid reversal signal. It's a very solid reversal signal. Gaps should be about the same price level. Notice my formation here. The gaps are about the same price level. And the larger the gap, the more important. Now, I put an interesting note in here. I told you I don't always agree with Thomas Bulkowski. He makes a big stink that this is a crappy pattern. I mean, he just comes right out and says it's a horrible pattern. He ranks it as his worst performing reversal pattern. And I think the guy was smoking crack, and I mean it. I have traded a bunch of island reversals, and I personally have found they're an excellent pattern. So I don't know where he got his statistics for it. I don't know what he was studying, but I personally have found that island reversals are excellent. The problem with Bulkowski putting this stat out there that they're not very good patterns is other people will quote him and say they're not good patterns. In fact, it made it all the way into the main textbook for the Market Technicians Association, and I think that, again, they just didn't do their homework. This is an excellent pattern. I've traded it many, many times. They don't always play out, but some of the biggest trades ever that I've ever traded have been island reversals. Take a look at this Google island reversal. This was a huge trade. Look at this. We traded up, had a nice move up in through here, had an exhaustion gap. 4 days later, we broke away, had a breakaway gap. We came back. We almost tested it, not quite, had a little continuation. That was a move from 650 down to 575. Don't tell me that's not profitable. That's a profitable move, right? And now take a look at this one. This is possibly my favorite. I called this one in Power Trader last July 2011. We had the exhaustion gap. We had the breakaway gap. And this was on Netflix. Ladies and gentlemen, this is one of the biggest trades that we've ever tracked in class. And it happened on Netflix last year. It followed this island reversal pattern. Excellent, excellent formation. Had the exhaustion gap after Netflix had gone from, like $100 to $300. You don't see all that on the chart, but if you came all the way far enough back, you would see that we had a massive move. We had the little island reversal. The trade reversed. We got a flag pattern, another flag pattern. Now watch this. Here's your runaway gap. We can measure that from 275 down to 200, about 210, I guess. So it was about a $65 move. Then we went from 175 down to about 110. So there was another $65, $75 move. And then we had the exhaustion gap. So there you see all three of them. Actually, you see all of them. Everything we just talked about, all on one chart. It's an incredible picture in the study of gaps right there. Netflix, amazing. You had the island reversal, right there, breakaway, runaway, exhaustion, and then it based down here, and it died out for quite a while. Then we actually had a breakaway in the opposite direction that was profitable, but then it turned into kind of a neutral trade, and currently Netflix hasn't gone very far, but been a very, very interesting stock to follow. And, again, I don't care what Bukowski says. I personally think the island reversals are great little trades. So, I like them. But anyway, all right, there are your gaps. There are your continuation patterns. Here are your action steps. I want you to do those quizzes. They're good for you. It's kind of like taking your vitamins. You just do it because it's the right thing to do. Look through several charts. Practice identifying chart patterns. Look for gaps. They are everywhere. Watch how they play out. Watch the ones that, kind of didn't play out, and just work with them. Start practicing them in your virtual accounts, virtual trade them. See if you can't make some profits on some virtual trades using these patterns. After tonight, you now have all of the chart patterns and you have all the gaps. So we're really rounding the corner in terms of core technical analysis. These first 4 classes of level 2, we've gone through Dow theory, the basic theories of why technical analysis work. Now you've got 2 classes on chart patterns. Starting up next week, when we get back together, you'll be getting into candlestick patterns, and we'll go through a bunch of candlestick patterns next week. Very interesting discussion. I think you're going to really enjoy that talk as well. All right. What questions or comments do I have? One question that I'm going to address because I've seen it several times in here. As they say, when do I get in? Ladies and gentlemen, you're overthinking it. Talking about that island reversal. When do you think you should have gotten in? As soon as you see the gap. And then you put your stops up in here. And if the trade doesn't continue, then you stop out. If the trade continues, you're in the trade. There's not a whole lot of confirmation you need after a gap. It is a confirming signal. All right. All right, excellent. You're welcome, Frank. Patricia, when you see it, yeah, exactly. Edward, I'm not sure if the quiz for class 11 is posted, but if it's not, it will be very shortly. Very, very shortly. LR, I'll try to get these notebooks posted. I'll go report to Paul in the next 3 minutes that there's a couple patterns missing from the notebooks. So you're missing pennants and you're missing runaway gaps. Both of those were somehow missing. So we will get that resolved. Thank you for those of you saying you really enjoyed the new classes. I'm happy for that. I'm curious what you guys are enjoying so much because, a lot of this, especially this level 2 material, the largest majority of it is almost identical to what we had before. It really is. You loved the old stuff too. Oh, you're so sweet. All right. All right. Well, I tell you what, ladies and gentlemen, let's call it an evening. Dennis, appreciate your commentary about posting that. I actually am not going to promote that because I very, very strongly believe in intellectual property rights. And so I would rather that I not know what you have done, and I'll leave it at that, Dennis. But you need to really be cautious, Dennis, because you can get in big trouble for what you're doing. I know you have the right intention, but sometimes the right intention is still not right. Just because you mean well doesn't mean it is well. All right. All right. Well, I'll tell you what, guys, you have an awesome evening. Have a great weekend. Have a great Thursday, a great Friday. Happy trading to all of you. And I'll see you Monday night when we start jumping into candlesticks. Good night to all of you. We'll see you next week.